So imagine selling over $1.6 billion of your company's core assets in just 6 months.
Right, which is just a staggering amount of money.
Massive. And then you completely pull up stakes, right? You just abandon the largest state economy in America.
Just completely pack up and leave.
Exactly. And that is the high stakes gamble we're digging into today. Welcome to Talk Tickers, the deep dive where we break down corporate earnings calls for retail investors like you.
Yeah, we like to keep it data forward, but, translate it into plain English.
Right. No Wall Street jargon here, just actionable takeaways. I mean, we're going to give you our opinion on whether these results are strong or weak and what it actually means for you if you're holding or maybe considering buying the stock.
And today's stack of sources is just wild. We are looking at Camden Property Trust, their Q2 2026 earnings call specifically.
Yeah. Camden, or CPT for short, they're a major real estate investment trust, or REIT. And our mission today is to figure out why they abruptly exited California.
And how they're navigating this 50-year high in apartment oversupply down in the Sunbelt.
Which is crazy to think about. So we're going to structure this deep dive around 4 things, right? The headline numbers, the story behind those numbers, management's guidance for the future, and finally, the bottom line. Is this a bullish or bearish signal?
So let's just jump right into the headline numbers, because this is a remarkable sequence of events.
It really is. Usually these quarterly earnings calls are, they're incredibly boring.
Yeah, highly predictable. Mm-hmm. A little revenue growth here, maybe some expense trimming there.
Right. But the scale of what Camden executed over this 6-month period, it completely defies that norm. I mean, they fundamentally rewired the geography of a multi-billion-dollar corporation.
They absolutely did. So let's start with the catalyst for all this, the move that essentially funded this entire corporate rewiring.
The Great Migration, basically. We're talking about a single monumental exit from the West Coast. Camden sold its entire operating portfolio in California.
And just to put the specific numbers on the table from the transcript, that is 11 operating communities.
Right, which makes up 3,620 apartment homes.
And they sold all of it for $1.6 to $5 billion.
Which is just a number so big it kind of washes over you.
Yeah, it's hard to conceptualize. And keep in mind, they had operated in that state for 28 years.
Oh, wow. So this wasn't just a quick flip.
Not at all. They had deep, deep roots there, a massive operational footprint, and they just decided to completely sever it.
Okay, let's unpack this, because looking at the notes, the average age of those California apartment buildings was 19 years old.
Right, 19 years.
So rather than looking at this as just a dry real estate transaction, I'm kind of thinking of it more like maintaining a massive old oak tree in your yard.
Okay, I like that analogy.
Right. So for decades, this tree provided great shade, and that shade is your steady rental income.
Makes sense.
But recently, the roots have started cracking your foundation. The city is charging you a fortune in specialized arborist fees just to keep it standing.
Yeah, the regulatory fees.
Exactly. And every time a storm rolls through, you're terrified a heavy 19-year-old branch is going to crash through your roof.
And it's going to cost a fortune to fix.
Right. So instead of constantly paying to maintain this massive aging organism in a highly restrictive environment, you just chop it down.
You sell the premium wood.
Yes. Yeah. You take the cash and you plant a whole orchard of young, fast-growing saplings in soil that actually wants them to grow.
That captures the operational reality perfectly. I mean, the shade was still there, right? The properties were still generating rent checks.
Sure, the top-line revenue looked fine.
But the friction of keeping that tree alive was compounding every single year. When we look at commercial real estate, there's this dangerous tendency to only focus on that top line revenue.
Right, just the rent coming in.
Exactly. But there is a massive, often invisible operational layer underneath that. And leaving California entirely eliminated a highly specific, very expensive regulatory spend for Camden.
The earnings call actually put a very specific number on that friction, didn't it?
It did. They stated that their regulatory and advocacy spend in California was eating up 80 basis points of their net operating income, or NOI.
Okay, let's translate that for you listening. 80 basis points is 0.8%.
Right.
If you just hear that in passing, 0.8% sounds like a rounding error. Who cares?
Yeah, it sounds timey.
But when your net operating income is hundreds of millions of dollars, 80 basis points is a massive recurring bleed on your cash flow.
It's millions of dollars.
Exactly. It's money that doesn't go to fixing the buildings, it doesn't go to the employees, and it definitely doesn't go to the shareholders. It just vanishes into the machinery of bureaucracy.
And that 80 basis points, that's just the start of the financial relief they got from this move.
Really? What else was bleeding them?
Well, by shedding these 19-year-old buildings, Camden projects their recurring capital expenditures will drop by 5% per unit across their new portfolio.
Okay, just to be clear for everyone, recurring capital expenditures, CapEx, we're talking about the unsexy stuff.
Very unsexy.
Like replacing 30-year-old HVAC systems or tearing up and repaving massive parking lots.
Putting new roofs on 50-unit buildings. Exactly. The things that don't necessarily allow you to charge more rent, but that you absolutely have to do just to keep the building habitable.
Right. You can't charge a premium just because the roof doesn't leak. It's expected.
Precisely. Furthermore, the call highlighted that their bad debt is expected to decrease by 10 basis points. It's going to drop down to about 0.4% for their new same-store portfolio.
Bad debt meaning rent that a tenant owes, but the landlord simply cannot collect.
Correct. And in markets with incredibly strict local eviction moratoriums or just complex tenant dispute processes, bad debt can pile up rapidly.
Because you can't get them out.
Right. The legal mechanism to resolve the non-payment is slow and it's expensive. So shedding that operational friction was a massive priority for management.
It really paints a picture of like death by 1,000 cuts. I mean, the earnings call even mentioned a single transaction in Los Angeles that just blew my mind.
Oh, the transfer tax.
Yes. When they sold one of the properties, they had to pay over $7.5 million just in transfer taxes.
It's wild.
Over $7 million simply for the administrative privilege of handing the title to a new buyer.
Which is likely a reference to measures like Los Angeles's Measure ULA.
The so-called mansion tax.
Right, which imposes a massive percentage fee on real estate transactions over a certain dollar threshold. Right. And this perfectly illustrates the broader strategic philosophy here.
What's fascinating here is that this exit wasn't a panic move, was it?
Not at all. It was a calculated offensive play based on decades of hard demographic data. Executive Chairman Rick Campo actually brought up a really fascinating analogy during the call.
Yeah, he compared this macro demographic shift to the World Cup, which was such an unexpected way to frame real estate economics.
It really was.
How exactly did he connect global soccer to apartment buildings?
Well, he looked at the infrastructure and the global perception of American cities. He pointed out that the last time the United States hosted the World Cup was 32 years ago, right? In 1994.
Right.
Back then, 9 U.S. cities hosted games, and only 2 of those host cities were in the Sunbelt.
Dallas and Orlando, I think.
Exactly. Dallas and Orlando. Now, fast forward to the present, gearing up for the 2026 World Cup. 11 U.S. cities are hosting games, and the Sunbelt representation has doubled.
Wow.
And Camden actually has a significant presence in all 4 of the Sunbelt host cities this time around.
Yeah.
Houston, Dallas, Miami, and Atlanta.
Okay, that's actually a brilliant proxy for relevance. Like, where does the world want to be?
Right, where's the energy?
Where is the infrastructure, the population base? I mean, to host an event of that magnitude, a city needs massive hotel capacity, modern transit, international airports, a booming local economy.
Exactly. And the fact that the center of gravity for those things has shifted so dramatically south over 30 years is incredibly telling.
And Campo's underlying point is that this reflects a staggering 30 to 50-year compounding trend.
It completely dismantles the narrative that the Sunbelt boom was just, a pandemic era blip.
Right, where everyone just temporarily worked from home to escape strict lockdowns.
Exactly. This is a multi-decade compounding of population growth, corporate relocations, employment growth. These markets have gained stature on a global scale.
Okay, I see the logic. I really do. But I have to play devil's advocate and push back here for a second.
Sure, go for it.
Because California is still the largest state economy in the United States. Depending on the quarter, it's like the 5th or 6th largest economy in the entire world.
That's true.
Isn't it incredibly risky for a massive real estate corporation to just completely abandon a market that huge? I mean, aren't they putting all their eggs in a Sunbelt basket that is famously prone to boom and bust cycles? We've all seen the history of housing crashes hitting places like Phoenix and Miami incredibly hard.
It is the exact risk assessment that any institutional investor has to weigh. And to understand why they made this choice, We have to translate this into plain language and separate the top-line macroeconomic size of a state from the bottom-line efficiency of operating a business within it.
Okay, break that down for me.
Yes, California's gross domestic product is massive. But for a real estate operator, if your capital is tied up in 19-year-old assets that require constant, expensive maintenance,
Right, the new roofs and HVACs.
and local regulations heavily restrict your ability to raise rents, while your fixed expenses like insurance and taxes just skyrocket, your actual yield shrinks.
And yield is the magic word here. For you listening, yield is the actual return on the money you have deployed.
Precisely. And this is where we have to look closely at the metrics Camden uses. On the call, they stated the trailing 12-month funds from operations yield, or FFO yield, on the California sale was 5.6%.
Okay, hold on. Before we go further into the weeds of those percentages, you keep using the term FFO, funds from operations.
Right.
Why aren't we just talking about standard profit or net income, like we would if we were analyzing a tech company or a retail brand on talk tickers?
That is a crucial distinction, and it goes right to the heart of how real estate accounting works. If you look at standard net income for a real estate company, it is heavily distorted by depreciation.
Distorted how?
Under standard accounting rules, the IRS assumes that a physical asset, like an apartment building, degrades in value over time, usually over 27.5 years. So every single year, a company has to deduct a massive depreciation expense from the revenue on paper.
Right, okay. Like how a tractor or a delivery van loses value every year because the engine just wears out.
Exactly. But in the real world, well-maintained real estate generally appreciates in value, or at least holds its value, especially in desirable markets.
So the accounting doesn't match reality.
Right. So if a REIT only reported standard net income, it would look like they were barely making any money, or even losing money because of this massive phantom depreciation expense.
Got it. So funds from operations, or FFO, corrects this.
It takes that net income and adds the depreciation back in. It gives investors a much clearer, more accurate picture of the actual cash the buildings are generating.
Okay, that makes total sense. So they were getting a 5.6% FFO yield on the California properties.
Yes. And here's the kicker regarding why they sold exactly when they did. The buyer of those California properties is instantly going to face a massive headwind because of a specific piece of California legislation, Proposition 13.
Prop 13, the famous property tax law.
Right. Passed in 1978, Prop 13 limits property tax increases in California to a 2% annual cap as long as the property isn't sold.
Right.
So Camden, having owned some of these properties for a long, long time, was paying property taxes based on a much older, lower assessed value.
Oh, I see where this is going.
But the moment the property is sold, it gets reassessed at the current, much higher market value. The earnings call noted that because of this reassessment, the buyer's yield is instantly going to drop by about 30 basis points just from the new, significantly higher property tax bill.
Wow. So Camden basically got out while the getting was good.
They did.
They shed the aging buildings, they eliminated the 80 basis points of regulatory friction, and they basically handed a ticking property tax time bomb to the buyer.
Exactly.
But, okay, they successfully executed the sale, which leads to a massive immediate problem. You just prune the tree, you sold $1.5 billion of real estate.
Yep.
If you just take that $1.625 billion and let it sit in a corporate bank account, the IRS is going to knock on your door with a tax bill that would absolutely devastate the company.
Which brings us to part 2 of our deep dive, the story behind the numbers. Because this wasn't just a divestiture, it was an incredibly complex, high-wire act of capital allocation.
Right, they had to shield this money immediately.
And reading through the sources, they achieved this through a crash course in 2 highly specific financial maneuvers, N31 exchanges and stock buybacks.
Okay, let's tackle the tax shield first. What exactly is the mechanism of a 1031 exchange, and why is it so critical here?
So a 1031 exchange, which is named after Section 131 of the U.S. Tax Code, is arguably the most powerful wealth-building tool in the American real estate system.
Big statement. How does it work?
Mechanically, it allows an investor to sell a property and completely defer paying capital gains taxes on the profit. But you have to follow incredibly strict rules to reinvest all the proceeds from that sale into a new like-kind property.
So it's essentially the monopoly rule.
How do you mean?
You trade in your 4 greenhouses to buy a red hotel, and the bank doesn't penalize you for the trade as long as you keep your money moving forward on the board.
That is the perfect way to visualize it. You keep the capital compounding, but the timeline is brutal.
There's a ticking clock.
A very fast one. The IRS does not let you sit on the cash while you leisurely browse the market. From the day you close the sale of your old property, you have exactly 45 days to formally identify the new properties you intend to buy.
45 days is nothing in commercial real estate.
It's a sprint. And then you have 180 days to actually close the purchase. And you can't even touch the money yourself. It has to be held by a neutral third party called a qualified intermediary.
Wow.
If you miss a deadline by a single day or you fill out a form wrong, the tax shield drops and the IRS hits you for the full capital gains tax.
And for a real estate investment trust like Camden, failing a 1031 exchange isn't just a corporate tax problem, right? It's a massive shareholder problem.
Huge. Because to maintain their special tax status as a REIT, which allows them to avoid paying federal corporate income tax, they are legally required by the IRS to distribute at least 90% of their taxable income to their shareholders every year in the form of dividends.
Which is why people love investing in REITs, right? For that steady dividend income.
Exactly. But if Camden had simply sold the California portfolio and realized a massive taxable gain without using a 1031 exchange, that profit would be classified as taxable income.
Uh-oh.
To satisfy the IRS rules, Camden would have been legally forced to issue a gigantic one-time special dividend to all their shareholders.
Wait. If I'm a shareholder listening to this, wouldn't I want a massive special dividend? A huge unexpected check in the mail sounds fantastic.
Well, it sounds fantastic in November, but it feels terrible in April during tax season.
The tax man cometh.
Because that massive special dividend is taxed as ordinary income or capital gains for you, the individual shareholder. You would be hit with a massive personal tax bill.
Oh, that makes sense.
And whereas from a corporate strategy perspective, the company you invested in Camden now has drastically less capital. They just bled billions of dollars out of the company. It severely shrinks their asset base and their future earning power.
Okay, so Camden's management looked at this scenario and said, we can create significantly more long-term value for our investors by keeping the monopoly money on the board.
Exactly. So they meticulously earmarked a full $1 billion of the California proceeds specifically for 1031 exchange transactions.
Okay, so picture the pressure on the management team here. They have $1 billion burning a hole in a qualified intermediary's pocket.
Yep.
They have a strict 180-day ticking clock from the IRS, and they have a strategic mandate to buy exclusively in the Sunbelt.
Talk about stressful.
Right. What exactly did they acquire with that $1 billion?
Well, they executed with phenomenal speed. By the time of the Q2 call, they had already deployed $645 million of that earmarked billion.
What did they buy?
They acquired 7 different apartment communities across major Sunbelt hubs: Atlanta, Orlando, Nashville, Dallas, Phoenix, Tampa, and Charlotte. They also scooped up 2 strategic development land sites.
Nice spread.
And here is the critical metric. Remember that the California assets they sold had an average age of 19 years.
Yeah, the old oak trees.
Right. The new Sunbelt assets they acquired with that money, an average age of just 5 years.
Oh, wow. That is a staggering upgrade in asset quality. I mean, that entirely resets the clock on all those recurring capital expenditures we talked about earlier. You aren't replacing roofs on a 5-year-old building.
Precisely. And they secured a funds from operations yield of just under 5% on those newly acquired Sunbelt properties.
Okay, but hold on. I'm doing the math on the back of the envelope here.
Okay, let's hear it.
They sold $1.625 billion in California. They earmarked $1 billion for buying new buildings through the 1031 exchanges.
Right.
That leaves over $600 million completely unaccounted for. What happened to the rest of the cash?
And this is where the strategy shifts from just impressive to truly brilliant, in my opinion.
Let's have it.
They didn't force that remaining $600+ million into more physical real estate just for the sake of it. Instead, they took $694 million and spent it repurchasing their own stock on the public market.
Wow.
The call noted they bought back shares at an average price of $105.17 per share.
And to really understand why buying their own stock was such a masterstroke, we have to look at how real estate companies are actually valued on Wall Street.
Yeah, we need to talk about NAV.
Right. The earnings call notes delve heavily into the concept of net asset value, or NAV. Can you break down the mechanics of NAV for us in plain English?
Absolutely. Net asset value is basically the true north compass for understanding REIT valuation. Imagine you took every single apartment building that Camden owns across the entire country.
Okay, all of them.
You put them all up for sale individually on the private physical real estate market today. You take all the cash from those sales, you pay off every single penny of the company's corporate debt, and then you divide the remaining pile of cash by the number of shares outstanding.
So it's basically the liquidation value.
Exactly. That final number is the net asset value per share. It is the literal private market value of the underlying bricks, mortar, and land.
Okay, so real estate analysts and institutional investors looked at Camden's actual physical buildings, ran the math, and determined that the consensus NAV was roughly $130 per share.
Right.
If you liquidated the company tomorrow, the buildings are worth $130 a share.
Exactly. The physical buildings hold a value of $130 per share in the private market. However, Camden doesn't trade on a private market.
It trades on the public stock exchange.
And public stock markets are incredibly volatile, right? They trade based on daily sentiment, fear, macroeconomic anxiety, panic over interest rates.
Just general noise.
Exactly. Because of all that noise, the public market was pricing Camden's stock at roughly $105 a share.
Okay, so if I'm the CEO of Camden, I'm looking at two options to spend my remaining $600 million.
Let's hear them.
Option A, I can go out into the Sunbelt, find a private developer who just built a nice apartment complex, and buy it from them. But I have to pay full private market value. I am paying $130 of cost for $130 of value.
Right. A fair trade.
Option B, I look at my own stock ticker and I realize I can buy my own high-quality existing real estate portfolio buildings I already know, manage, and trust by simply buying my own stock off the public exchange for $105.
They realized they had an opportunity for massive capital arbitrage. I mean, why would you overpay for physical buildings on the open market, dealing with brokers, inspections, and new market risks when Wall Street is essentially holding a fire sale on your exact same quality buildings via your own stock?
It's a no-brainer.
By executing this stock buyback at 105 against a true value of 130, they essentially bought real estate at a massive 20% discount.
20%.
And by doing so, they achieved an implied FFO yield of 6.4% on that deployed capital.
Which is an incredible number when you stack it up against the alternatives. I mean, 6.4% is significantly higher than the 5.6% yield they were getting in California.
Yep.
And it's much higher than the 5% yield they were getting on the new physical buildings they just bought in the Sunbelt.
It is textbook capital allocation. They sold high in California, taking advantage of private market buyers who were still willing to pay premium prices despite the operational friction and the looming property tax reset.
Right.
And they bought low the public stock market, taking advantage of Wall Street's irrational discount. Camden CEO Alex Jessett explicitly stated on the call that they view Camden stock as a screaming buy.
A screaming buy. You don't hear CEOs use language quite that strong very often.
They really don't.
The logistics of executing all this are just mind-bending, though. Rick Campo noted on the call that completing $3.25 billion in total transaction volume in just 6 months required absolute precision.
You're swapping the engines while the plane is in midair.
Exactly. You have to negotiate the sale of the old assets, ensure those 19-year-old buildings are still operating perfectly so the buyer doesn't get cold feet and back out.
Right.
Then you got to hunt down and close on 7 new assets across different states within a 180-day IRS window. And on top of all that, quietly execute a massive stock buyback.
It's a lot of plates spinning.
And the craziest part of the guidance they issued, they structured this so perfectly that this massive rebalancing is projected to be completely FFO neutral in year 1.
Which means that despite selling off a massive chunk of their revenue-generating property in California, their overall profit per share is not projected to drop this year.
They perfectly threaded the needle between the lost income and the new income.
And the real payoff is what happens next year, right?
Right, because it becomes accretive.
Yes. Accretive, meaning it actively increases their profit per share in year 2. The logic is simple. A 5-year-old apartment building in a high-growth, business-friendly market like Atlanta or Dallas is going to organically grow its rent and require significantly less capital maintenance much faster than a heavily regulated 19-year-old building in California.
The young Sunbelt portfolio will rapidly outcompound the old West Coast portfolio.
Exactly.
Okay, so they've brilliantly shielded their money, they've bought these young Sunbelt properties, and they've bought back their own stock at a massive discount. On paper, they look like absolute geniuses.
They do.
But there is a massive elephant in the room here. If you live anywhere in the Sunbelt right now, you know exactly what I'm talking about.
Oh, yeah. The supply.
There is a brand new, half-empty luxury apartment complex on practically every single corner. Camden is walking right into the teeth of a historic macroeconomic crisis.
And that reality introduces a massive headwind to their entire thesis. We have to lay out the macro environment to understand what they are up against. Because if you read the financial press or any housing market analysis right now, the narrative around Sunbelt apartments is basically doom and gloom.
It's terrible.
The multifamily real estate market is currently digesting a 50-year high in new supply.
50 years. That means we haven't seen this many apartments being built at the same time since the 1970s. How did the market get so oversupplied so fast?
It was a perfect storm of capital and demographics. Over the last few years, driven by zero interest rate policy, ZRP, during the pandemic, money was practically free to borrow.
Right, interest rates were essentially zero.
Combined with the obvious demographic migration trends we just discussed, everyone fleeing to the Sunbelt, every institutional developer in the country looked at the exact same data.
And they all had the exact same idea.
They all borrowed cheap money, bought land in Texas, Florida, and Arizona, and started pouring concrete. But large apartment buildings take 2 to 3 years to build.
Oh, so there's a lag.
A huge lag. So a project funded in 2021 or 2022 is opening its doors right now. Millions of units are hitting the market simultaneously.
Which means sudden, massive competition. If I'm a renter in Dallas, Atlanta, or Nashville, my options have just exploded.
You hold all the cards.
I suddenly have 5 brand new luxury apartment buildings on my block, all of them desperate to hit their occupancy targets, and all of them begging me to move in.
And when supply spikes exponentially like that, landlords completely lose their pricing power. The macroeconomic data is stark. Rents across the multifamily industry have essentially been flat or even slightly down for 41 consecutive months.
Wow.
We have had over 3.5 years where apartment owners simply could not meaningfully raise rents because there was always a brand new empty building down the street offering incredible incentives to steal their tenants.
So wait, if the Sunbelt is drowning in new apartment buildings and rents have been completely stagnant for 3.5 years, I have to ask, how does this massive California rotation make any sense?
I know it sounds counterintuitive.
Why on earth would Camden take $1 billion in cash and double down on buying physical buildings in the Sunbelt right now? Aren't they just buying into a falling knife?
It absolutely looks that way if you only look at a static snapshot of the market today. If you only look at the sheer volume of supply, it looks terrifying.
Right.
But successful real estate investment is about looking at the second derivative, the rate of change and the underlying absorption of that supply.
Okay, explain that.
Well, the Camden management team spent a significant portion of this earnings call vigorously defending their thesis, and they detailed why they believe the worst of this 50-year supply glut is finally over. And they used a fascinating case study to prove it. Austin, Texas.
Austin is the perfect battleground for this debate. It has been the absolute poster child for the Sunbelt supply glut.
It really has.
A few years ago, it was the hottest market in the country. Tech companies were relocating, Elon Musk was building gigafactories, and developers poured into Austin like it was a gone rush.
And the predictable result was that Austin became one of the most wildly oversupplied markets in the United States. And because developers were desperate to fill these new buildings, Austin became a heavily concession-driven market.
Just to define that for a second, when we talk about concessions, we are talking about landlords giving away free stuff to get a tenant to sign a lease, right?
Exactly. It's industry jargon for incentives. Instead of lowering the actual stated rent on paper, which devalues the building in the eyes of the bank, a landlord will offer 1, 2, or sometimes even 3 months of free rent up front.
Or free parking, or waived amenity fees.
Right. When concessions are high, the effective rent, the actual cash the landlord collects, over a 12-month lease plummets, even if the asking rent on the website stays the exact same.
Okay, so Austin is drowning in supply. Developers are handing out free rent just to get bodies in the door. It sounds like a bloodbath for landlords.
It was tough.
But then, on the earnings call, Camden's president and chief operating officer, Lori Baker, revealed a data point about their Austin portfolio that made me do a double take.
It was arguably the most surprising metric in the entire transcript. Camden's occupancy rate in Austin jumped 190 basis points from the first quarter to hit a staggering 96.6% in July.
Wait, I gotta push back on that. How is 96.6% occupancy mathematically possible?
Sounds fake, right?
If developers just finished thousands of new units in Austin this year, who are all these people filling Camden's buildings? Are they just giving the apartments away for free to artificially pump up their occupancy numbers for Wall Street?
It's a very valid suspicion, and a lot of analysts probably thought the same thing. But the subsequent data they provided refutes that. Because if they were just giving the apartments away, their lease rates would be cratering.
Okay.
But the rate of signed new leases in Austin actually showed a massive recovery. In March, signed new leases in Austin were at a bleak negative 11%.
Meaning they were forcing Camden to sign new leases for 11% less money than the previous tenant was paying just to keep the unit occupied.
Correct. They were taking a huge haircut. But by July, just a few months later, that metric had improved to negative 3%.
So it's still negative. They are still taking a slight haircut compared to a year ago, but the momentum is violently shifting upward. An 800 basis point improvement in just a few months is massive.
As his CEO Alex Jessett pointed out, it is the highest improved momentum among all major U.S. markets. And the answer to your question, where are all these people coming from, is that the underlying demand is still incredibly robust.
People are still moving there.
Yes. Developers built too much, too fast, sure, but people never stopped moving to Texas. Camden noted that the broader Austin market absorbed over 11,000 units in just 12 months.
Meaning 11,000 new households actually moved in and signed leases.
Exactly. They are rapidly chewing through that excess supply because the demographic thesis, the World Cup thesis we discussed, is still fully intact.
And reading through the rest of the call, it wasn't just isolated to Austin. Management spent a lot of time pointing out what they called green shoots, early systemic signs of recovery across their entire national portfolio.
Like what?
Well, for instance, they noted that in July, almost 50% of Camden's communities nationwide had positive signed new leases. That is up from only 20% back in March.
And the most compelling evidence of these green shoots came from their dynamic pricing software.
The algorithm.
Right. Modern real estate operators don't just guess what rent should be. They use complex algorithms that analyze daily supply, demand, competitor pricing, and web traffic to adjust rents every single day.
Kind of like airline tickets.
Very much like airline tickets. Jessett noted that for a few specific days in July, the algorithm actually detected enough localized demand to push the average rent positive across the entire national portfolio for the first time in several years.
The software essentially woke up and said, wait, the empty buildings down the street are finally full. We can raise prices again.
That is the literal definition of a green shoot.
And the call was fascinating because they really dug into the regional nuances of this data. A national portfolio isn't a monolith. It's a collection of highly specific local ecosystems. Like, the discussion around Phoenix was wild.
Phoenix is a prime example of why local knowledge matters. Jessett actually joked on the call about being amazed that anyone would even look for an apartment in 120-degree heat.
Yeah, he was referring to Phoenix's reverse seasonality.
Right. In almost every other market in the U.S., summer is the absolute peak leasing season. Families want to move before the school year starts.
Makes sense.
But in Phoenix, the summer is so brutally hot that leasing traffic dies down, and their peak season is shifted to the cooler months. Furthermore, he noted that Phoenix is currently a tale of two entirely different markets.
Right. He pointed out that the east side of Phoenix is vastly outperforming the west side in terms of absorbing supply and growing rent.
And completely by design, Camden's Phoenix portfolio is 100% concentrated on the east side.
It proves that you can't just buy a macro trend. You can't just buy Phoenix. You have to buy the correct neighborhood in Phoenix.
Exactly. They also highlighted Denver, which had been struggling heavily under its own supply wave. But Denver saw a massive improvement in effective lease rates, moving from negative 7.7% in the second quarter to negative 4.3% by the time of the earnings call.
So if we connect all these localized data points, Austin absorbing 11,000 units, the dynamic pricing software ticking positive, Denver improving, It all feeds into a very specific macroeconomic theory held by Camden's management regarding the future of the housing market.
The hockey stick recovery.
Exactly. They refer to it as the hockey stick.
And this theory is the bedrock of their entire billion-dollar rotation strategy. Jessup made a self-deprecating joke about being from Texas and not really knowing what a hockey stick looks like, but the financial concept is crucial to understand.
Right now, the broad market consensus is suffering from severe recency bias, aren't they?
Big time. Because rents have been flat or down for 41 months, many Wall Street analysts are projecting that rents will just stay flat for the next 3 to 4 years. They expect a slow, agonizing slog.
But Camden's chief financial officer, Ben Fraker, pushed back incredibly hard on that narrative. He pointed out the mechanical reality of how real estate development works. This 50-year high in supply is anomalous, and more importantly, it is temporary.
Exactly. Because interest rates have spiked, and construction materials and labor costs remain heavily elevated, regional banks have essentially stopped lending money for new apartment construction.
The money printer turned off.
The pipeline has completely frozen. If a developer wants to build a new complex today, they simply cannot get the math to work to secure a loan.
And as we established earlier, it takes 2 to 3 years to build one of these complexes. So if a developer doesn't break ground today, there is absolutely zero new supply opening its doors in 2027.
The supply side of the equation is mathematically guaranteed to plummet off a cliff in 2027 and 2028.
But what about the demand side?
Well, Fraker pointed out that domestic in-migration is actually accelerating. The data from their tenant screening shows that 16% of new Camden renters are still migrating from completely outside the Sunbelt.
Wow, 16%?
That number was 15.5% a year ago and 14% the year before that. The demand isn't disappearing, it's growing.
So you have a situation where demand is acting like a tightly coiled spring. More and more people are moving south, constantly building pressure. Right now, in 2026, that pressure is being safely absorbed by this massive, anomalous wave of new pandemic-era construction.
But the exact second that construction wave stops hitting the market,
the spring violently snaps.
The compounding demand instantly outstrips the suddenly restricted supply. And instead of rent growth slowly crawling up 0.25% a year, it sharply and aggressively accelerates upward.
On a graph, the line goes flat for a few years and then spikes vertically. It forms a hockey stick.
Fraker even looked back at history to prove this isn't just wishful thinking. He compared the current setup to the post-financial crisis era.
Right, 2008, 2009.
After rents dropped significantly in 2009 and 2010 due to the housing crash, they didn't recover slowly. From 2011 to 2019, when supply was constrained, rents averaged around 4% growth, hitting peaks of 6.5%. When the pivot point hits, the pricing power returns violently to the landlord.
That is the ultimate bet they are making with the California money. They are deliberately buying 5-year-old assets right now during the absolute muddy bottom of the pricing cycle when everyone else is terrified of the supply glut.
They are fully expecting to ride the blade of that hockey stick in 2027 when the new buildings stop opening.
It is a massive, incredibly confident, long-term strategic bet, but it raises a huge, immediate operational question. If the much-anticipated hockey stick doesn't arrive until 2027 or 2028, how does Camden survive the lean years right now?
That's the billion-dollar question.
With rents still essentially flat, how do they protect their profit margins? I mean, they have to ruthlessly cut costs and optimize every square inch of their newly minted national portfolio.
And that operational necessity brings us to a fascinating technological pivot. Because how they are achieving this optimization is not through traditional cost cutting, like just firing people, but through an aggressive deployment of artificial intelligence.
When I think of commercial real estate, I generally think of bricks, copper pipes, and leasing agents with clipboards. I don't necessarily think of Silicon Valley tech incubator.
Yeah, real estate is usually a dinosaur when it comes to tech.
But Camden is heavily leaning into AI. And what struck me in the sources is that they aren't just throwing the word AI into the earnings call to artificially boost their stock price.
Like a lot of companies do.
Exactly. They have a very specific, deeply ingrained corporate framework they call leadership, crowd, and lab.
It is a remarkably sophisticated approach to corporate innovation. Think about how traditional corporate software rollouts usually work.
It's a top-down mandate.
Right. An executive goes to a conference, buys a massive expensive software package, and forces the entire company to use it. And it's often a disaster because the software doesn't actually solve the day-to-day problems of the workers.
Camden is completely flipping that model.
Right. The leadership tier simply means the executive suite encourages and funds a culture of technological curiosity. But the crowd phase is where the actual innovation happens.
Explain the crowd phase.
They are intentionally empowering their frontline workers, the property managers on site, the maintenance technicians fixing the plumbing, the leasing agents giving tours, to identify their own daily inefficiencies and actively search for AI tools to solve them.
Because the person who actually deals with a broken HVAC system in a 300-unit building every single day knows exactly where the friction is in the workflow.
They understand the nuances of the problem far better than a software engineer sitting in a corporate office tower.
Exactly. Let's invent a hypothetical to make this concrete. Imagine a frontline worker, a maintenance supervisor, who notices that every time the temperature drops in Dallas, a specific type of pipe in a specific building always freezes, causing thousands of dollars in water damage.
Happens all the time.
In a normal company, he just fixes it and complains. At Camden, he flags this pattern and suggests that maybe predictive weather modeling could alert his team to wrap those specific pipes 24 hours before a freeze.
And that brings us to the third tier, the lab. Once that frontline worker in the crowd finds a potential AI solution or pattern, it moves to the corporate lab.
The sandbox.
Right. It's a secure environment where these grassroots AI ideas are rigorously tested. They ensure the AI doesn't violate tenant privacy. They test if it actually saves money. And if it works, they figure out how to scale that specific solution across all 170 properties nationwide.
Okay, so the methodology is sound, but what are they actually achieving with it? How does AI make an apartment building in Orlando more profitable?
It impacts the bottom line in highly tangible structural ways. One of the major applications they highlighted is optimizing lease renewal percentages.
This one is fascinating, and honestly, if you are a renter listening to this, this is exactly what you are up against in the modern housing market. Tell us how the AI handles a lease renewal.
So traditional lease renewals are often just a flat percentage increase dictated by a regional manager, right? Everyone's rent goes up 3% this year.
Pretty standard.
But Camden's AI algorithms analyze a staggering amount of data to predict human behavior. The software looks at a resident's payment history, how many maintenance requests they've submitted, the current supply of competing apartments within a 2-mile radius, seasonal moving trends, and historical data on how much friction that specific demographic is willing to tolerate.
It's profiling them.
The AI calculates precisely when a resident is most likely to renew and exactly what price point they will accept without deciding the hassle of packing boxes and moving is worth it.
It is entirely removing the human emotion and guesswork from pricing. And by predicting that exact friction point, they maximize the rent increase without pushing the tenant out the door.
Which is critical.
Because preventing a unit from going vacant is incredibly valuable. When a tenant moves out, the landlord loses a month of rent, has to pay painters, has to clean the carpets, and has to spend money marketing the empty unit.
Exactly. Preserving cash flow by keeping occupancy high is paramount during a supply glut. But AI isn't just being used on the revenue side, it's aggressively attacking the expense side. And the biggest target on the expense side right now is property insurance.
Yeah, the sources noted that property insurance currently makes up a staggering 7% of Camden's total operating expenses.
That is a massive chunk of their budget.
The insurance market in commercial real estate is an absolute crisis. The climate is increasingly volatile, the cost of construction materials to rebuild after a disaster has skyrocketed, and insurance premiums have surged industry-wide.
Particularly in the Sunbelt states like Florida and Texas, where Camden is heavily concentrated.
Right.
So Camden is using AI to predict and mitigate property insurance claims before they happen.
How so?
By analyzing massive data sets of where and how claims occur. Whether it's identifying historical patterns in slip and fall workers' compensation claims, or predicting water intrusion based on hyperlocal weather data and building materials, they can proactively dispatch maintenance to fix a vulnerability before it becomes an actual insurance claim.
It is the financial difference between paying $50 for a smart water sensor and paying a $50,000 deductible for a flooded floor that destroys 3 apartments.
Exactly. They also highlighted using AI to aggressively curb utility spend. The software constantly analyzes water consumption and energy use across thousands of units, instantly spotting anomalies.
Like a running toilet in a vacant unit.
Or a malfunctioning irrigation system. Things that a human property manager might not notice until the end of the month when the massive water bill arrives.
So when you weave all these threads together, the massive California portfolio reshuffle, the brilliant capital arbitrage of the stock buyback, weathering the worst supply glut in 50 years, and deploying a grassroots AI lab to squeeze pennies out of the margins, what is the actual result? How did Wall Street react to the scorecard?
This is where we get to management's guidance. And the forward guidance management provided was genuinely surprising in its resilience. Despite all this macroeconomic turmoil, and despite selling off $1.6 billion in revenue-generating assets in California, they maintained their full-year core FFO guidance midpoint at $6.75 per share.
$6.75. That goes back to the flawless execution we talked about earlier. They swapped the engines while the plane was in midair without losing altitude.
But the most revealing metric of their operational strength is their same-store net operating income, or NOI, projection.
Same store meaning they are only measuring the performance of buildings they've owned for a full year, right?
Right. Excluding the newly bought Sunbelt assets and the recently sold California assets. It measures the health of the core business.
Okay.
When they started the year, they projected their same-store NOI would be negative 0.9%. They expected their core buildings to make almost 1% less money than they did the year before, entirely because the historic supply glut was crushing their ability to raise rents.
But on this latest earnings call, they actually improved that projection. They moved it from negative 0.9% to negative 0.6%.
And the crucial part is why it improved. It didn't improve because they miraculously started charging higher rent.
Because they couldn't.
Right. It improved entirely because of the aggressive expense controls we just discussed. They specifically cited negotiating better trash contracts, lowering their water usage through AI monitoring, securing favorable insurance subrogation recoveries, and locking in insurance renewal pricing that came in better than originally anticipated.
They squeezed an extra 30 basis points of pure profit out of the buildings entirely through operational discipline.
Exactly. They can't force the market to accept higher rents, but they can ruthlessly push their internal costs down.
And looking ahead to the future, while they are entirely committed to this new pure play Sunbelt strategy, they did note that they plan to make some minor portfolio tweaks down the road.
Oh, like what?
They plan to slightly reduce their exposure in their two largest current markets, the Washington, D.C. metro area and Houston, Texas.
Which makes perfect sense from a risk management perspective. It's just basic diversification. You don't want too much of your corporate net worth tied up in a single geographic zip code, no matter how much you believe in the local economy.
A single hurricane in Houston or a massive government shutdown in D.C. could disproportionately impact the company.
It is purely for long-term allocation balance. Interestingly, they mentioned that they evaluated expanding into the Midwest. They noted that there is some population growth occurring there, driven purely by the search for affordable housing, but they ultimately decided to pass.
They passed on the Midwest.
Yeah. They are sticking firmly to their conviction that the Sunbelt is where the outsized long-term macroeconomic returns will be.
Which brings us to the bottom line, right? To wrap up this incredible corporate saga, it really is a masterclass in navigating economic crosscurrents. We watched a multi-billion-dollar real estate giant completely sever its ties with the state of California, intelligently shedding 19-year-old assets to escape a compounding web of regulations, taxes, and hidden operational friction.
It's an incredibly bold move.
We saw them execute a textbook capital allocation strategy, shielding that $1 billion in cash from the IRS via incredibly stressful 1031 exchanges, upgrading their portfolio to 5-year-old assets.
And brilliantly using the remaining cash to buy back their own heavily discounted stock in a massive arbitrage play.
We observed them weathering a 50-year historic supply glut in the Sunbelt, not by panicking or retreating, but by closely monitoring the data for green shoots, watching their occupancy rise to near capacity in deeply overbuilt places like Austin.
And positioning themselves perfectly for a violent hockey stick recovery when the new construction pipeline evaporates in 2027.
And finally, we saw them pioneering a new corporate structure by empowering their frontline workers to utilize an AI lab to squeeze every last penny of efficiency out of their trash contracts, utility bills, and insurance premiums.
Successfully protecting their margins when they needed it most.
It is a remarkable story of adaptation. I definitely call this a bullish signal for their long-term health. However, as we sign off, I think all of this raises one final, incredibly important question, a provocative thought for us to consider.
What's that?
Camden's entire multi-billion-dollar strategic pivot relies on one massive foundational assumption, that the 50-year demographic migration trend to the Sunbelt will simply continue indefinitely. But demographic trends are not laws of physics.
That is very true. They are entirely dependent on human behavior and environmental realities, which can absolutely change.
Exactly. With shifting climate realities, we just talked about those brutal 120-degree summers causing reverse seasonality in Phoenix. And you mentioned the insurance market being in crisis across Florida and the Southeast due to extreme weather risk.
Yep.
And add to that the simple economic fact that the Sunbelt is gradually losing its core advantage of affordability as more and more people move in and drive up the cost of living. Could we eventually see a plateau or even a reverse migration?
It is the ultimate contrarian scenario. Camden noted they briefly evaluated the Midwest, but passed. But if Phoenix continues to face water scarcity issues, or if parts of Miami become virtually uninsurable, or if Austin becomes just as prohibitively expensive as San Francisco, suddenly that Midwest affordability starts looking very attractive to the next generation of renters.
Will the Sunbelt's golden era last forever, or is that highly anticipated hockey stick recovery destined to eventually melt in the heat? It's a multi-billion-dollar question that will play out over the next decade.
It's definitely something to watch.
And it's something for you, the listener, to keep an eye on the next time you see a headline about thousands of people moving to Texas or Florida. Because when these massive demographic tectonic plates shift, they rewrite the economic map of the entire country.
Well said.
Thank you so much for joining us on Talk Tickers for this deep dive. Keep questioning the consensus, keep looking for those green shoots in your own investments, and we will see you on the next deep dive.